Hello, and today we're going to be having a look at value-added tax, VAT. So this was a tax that was introduced on the 1st of April 1973, and the idea of the tax is you are charging the final consumer of a good or a service, whichever one they've got, for the value that's been added to produce this good or service in question. So therefore the intermediary traders in making this product, in delivering the final product, should be allowed to recover any VAT that they've been paid. And there's two types of VAT. Well, there's not two types, but we can distinguish between two elements of VAT tax, which is the input tax and the output tax. So as a business, the input tax is a tax you are paying for things that you are bringing into your business. So, for example, if I was to make a table, then the wood, the glue, the varnish I'm bringing, the VAT I pay on that, that is the input tax. The output tax is a tax that the final consumer pays, and it's coming from outside the business. So it's that, and what you are paying as a business is the difference between the output tax and the input tax. So there are two conditions, however, for you to be able to recover input tax, and that is that you need to be a taxable person. So by this it means that you need to be VAT registered with an annual income of 81,000 per annum, and also you need to be acting in the course of a business. And how the courts interpret this is quite broadly, so it's the same legal principle of substance over form, so they don't care about the actual formal agreements or contracts or the way in which the entity is presented, but more like what is actually going on. Are there underlying business ideals in having this enterprise running? So things like that. So long as it's that, you can recover your input VAT. Now the implication of this is that VAT is then collected in stages. So because every business is just paying the difference between input and output, so you're collecting the VAT for one product in the course of however many business there are, how much value is added essentially to the final product. Now, as a general rule, you can recover input tax so long as the supply you are making is taxable. But before we even look at what we mean by taxable supply, we need to stand back for a second. Firstly, what do we mean by supply? So supply, we're talking about the goods and services you are providing as a business to your consumer. And the second question is what you are providing even a supply at all? So for example, where you transfer a business, and in that business there will be assets, there will be properties, there will be computers, there will be other kind of capital machinery, whatever it is, when you transfer that, that does not usually constitute a supply. And the reason is because that's viewed as a transfer of a going concern. Of course, this is conditional upon the fact that the purchaser will use the assets in the same kind of business and as a seller, and basically they're taking it for the sake of using the business in the similar way that has already been used. So you need to first distinguish between, is what you're doing providing a supply at all? Because if it's not, like transferring a business, then this does not apply to you. This only applies to where supplies are taxable. So then the second question to ask is this supply that you're making taxable or not? If it's not taxable, we call it exempt, VAT exempt. So quite a lot of different products are included in this, like educational services, property transaction, health services, financial services, insurance services. These are all included. And essentially what you're saying is, because the supply you're making is not taxable, there's no really input tax you can recover, because you're not doing any more the difference between it, because there is no output tax. It just doesn't exist because the supply is exempt. What you can do, however, in certain situations, but they are limited, they are restricted, is you can opt to have this exempt supply taxed. So if you really want to recover, you can. But remember, this will be restricted and there will be rules. So for example, if I'm making a supply of a certain type of property, but if I make it to a registered social landlord, then I cannot even opt to have this taxed if it's exempt. Just because that's what the rules say. So that's, you got to find out what is it exactly that you're selling. So now we've looked at if it's a supply, we've looked at if it's taxable at all. What about where the supply is taxable? Well, it doesn't stop there because there's 3 types of taxable supply. You have standard rated, reduced rated, and zero rated. So let's start with standard rated is the most basic one. This is where the VAT charge attracts is of 20%. It's just the standard one we pay for most things. So it would include, like, I don't know, shoes, staplers, umbrella, anything, whatever. Most things you pay 20% charge on. And so what you're saying is, so long as the output tax as a business is greater than the input tax, you will be able to recover all your input tax. And there are also certain rules governing where you sell mixed supplies and how they work. So when you're looking at a particular product, so say you're looking at a particular property and it's mixed, so part of it is exempt, part of it is taxable, what happens? Well, they can be apportioned if they are not incidental to one another, the 2 types of supply. Yet if they are incidental, you're looking at the dominant supply, and that is the charge that will be attracted. Then you also have reduced rated. This is where a 5% VAT charge is attracted. So it includes like children's car seats, home energy products, etc. And here again, so long as the output tax does cover your input tax, then you can cover all your input tax, and that's the end of that. Then zero rated supplies. This is where there is the supply is taxable, but it's 0%. So you might question, like, what's the point of this if you have exempt, which in practice, well, they both are like attracting no VAT charge to the final consumer. The thing about zero rated is, because it's still a taxable supply, it's just your output will always be 0 and your input will always be a number. So you'll always end up with this negative number when you do output minus input. And the implication of this is that then you can go to the HMRC and you can get a refund for the input tax you've paid in providing zero-rated supplies. And this is because zero-rated supplies are known as quite necessities, so like children's clothing, food, etc. These are all included in it. So those are the 3 different types of supply, and this is how to recover input VAT tax. Thank you for watching.